Good morning, everyone. Welcome to this market update for the 7th of April. It was a very positive week around the world last week. The US market has broken through the second of three resistance levels and now is only a bit over 1% off its all-time highs. We've seen a very nice resurgence continue in China and throughout some other parts of Asia. And there's generally a fairly positive tone to the stock market at the moment. So let's take a look at what we're going to cover this week. The trends really remain positive. There's really no negative signs in the market at all. Now that can of course change very, very quickly, but for the moment things looking fairly positive. US earnings season starts this week, so that's the next potential trigger for some greater fluctuations in the market. And as always, the early reporters tend to be some of the better ones. So I think the next week or so, which is particularly about the US financial stocks, we'll have JP Morgan, Wells Fargo, and I think Citibank reporting this week. So that will set the tone. We'll be looking at the normal stock and commodity trend update and portfolio analyst, amongst numerous things that I looked at. I did give some thoughts on active versus passive investing as a general process, and getting lots of excellent member questions at the moment. So that gave me the opportunity to analyse some stocks with some terrific potential. They're not necessarily buys now, but nevertheless, the business has great potential. So just a bit of a perspective on the process of investing, and this is just as important as doing stock research or doing technical analysis or whatever else you might do. Making money is as much about controlling your emotions as anything else. So don't ever downplay the importance of emotional control and psychology when it comes to the market. If you've done the research work, then I would suggest strongly that you trust your system, especially when it's not producing in the shorter term. So if you've done your homework, then have confidence that you just need to give it a bit of time for it to pay off. And you've only got to consider some of the price fluctuations that occur just constantly. And I'm going to look at an absolute classic in a minute to illustrate my point. And you see enormous fluctuations in the price that can't possibly be reflective of what's going on in the underlying business. We're going to look at Apple in a minute. And on a couple of occasions, the price of Apple has dropped between 40 and 50% over a period of 6 months, and then immediately recovered and got on to a new high. Now, there's no way that the business fundamentals of Apple can fluctuate to that degree. It's not possible. So therefore, you've got to accept that sometimes the market is over-optimistic and sometimes the market is just downright pessimistic. And that if you get thrown offline by short-term fluctuations, then you're going to be continually chasing your tail in the process of investing. So you've got to develop the art of ignoring the noise. And members will know over the last 6 months or so, I've been using the phrase quite a bit, and that is to learn to underreact to daily or short-term movements, because quite often they wash out fairly quickly. So the art of ignoring the noise is really important. Just before I go on to American stocks, let's just look at Apple. Sorry, let me get the right screen. There we go. No, that's not the right screen. There was the right screen. Okay, so let's look at Apple. So this is a weekly chart. Right over here on the left-hand side is 2011. So we're looking at about 8 years of price fluctuations in Apple. Now, the red line is the 200-day moving average, or sorry, it's the 200-period moving average. And you will notice that there has been a strong, consistent uptrend in Apple, which is what you'd expect, because as a business that's been expanding. But on a couple of occasions, the price has dipped significantly. So from September 2012 down to July 2013, so a bit under a year, the price moved from $100 almost back to $50. So a 50% reduction in the share price. Now, there's no way that the business went backwards by that degree. Let's wind forward to the middle of 2015. The price was trading at 133, and then it came back to below 90 in about 10 months again. We then advanced to a new high. The price probably got ahead of itself at $230, and we pulled back all the way back to 143. And now we're back up almost at $200 again. So if you've got a solid game plan and you've done the research and the price dips for a few months or even 6 months, then you've got to resist the urge to ask the question, what is wrong with the business? Because if you've done your research well, most of the time there's nothing wrong with the business. It's just the market is deciding to award that stock a different price for a period of time, and it will eventually recover. But this really illustrates the importance of knowing your target, knowing roughly what sort of price is a good entry price, and then just waiting for it to come back. And I'll come back and deal with that point more at the end, because it's a really vital point in terms of the tactics of how you invest. So American stocks last week had a very good week. They were up nearly 60 points, just over 2% for the week. So that's a strong week. And stocks really fired up on Friday night on some pretty strong jobs data that reversed what we'd seen in February. The fact is that worst case scenario has been priced in for some time, whether it be central bank policy, the US-China trade war, whatever it might be. The stock market is very good at pricing in those negatives, and so the logical direction is up. But I do note there are some signs of cooling in the US economy. So there's certainly some things that I'm watching. I don't have my head in the sand, and I'm just assuming that the US market is going to keep marching on. It may do, but just a few things in the manufacturing data that gives me a little bit of pause for thought. But look, overall, the US economy is still in the position of being good enough. It's not great. You can always poke holes in something if you want to, but it's good enough to sustain this rally. Asia is certainly looking up. China is looking better, and other parts of Asia are looking better. Europe's a mess. They really are in some significant trouble, considering that central banks have been stimulating like there's no tomorrow for 10 years, and here they are slipping into recession. So all that stimulation for a decade has effectively achieved nothing. So, how do they get themselves out of recession without the ability to lower rates, because the rates are already zero or in some cases negative? So, there's certainly some problems in Europe. Earnings season starts next week in the US, as I mentioned, so that's an important marker. And the US dollar continued to edge higher last week. 10-year Treasury yield moved back up a little bit to 2.5, but interest rates are still in a short to medium term downtrend. Let's take a look then at the main US indices. So the S&P, quite a meteoric fall into December, as we all know, and then an equally meteoric recovery, because really that really shouldn't have happened. That was really just an aberration, that period of weeks across there. We had resistance here at 28.15. We got above that. We then had the next level of resistance, which was the January 2018 highs. So off here, we've now beaten that one. So that's 28.75-ish. And now we've just a little bit off. 29.40 is the all-time highs. We're just 40, not even 50 points away from those all-time highs. And when you look at the breadth of the market, so let's look at the Russell, which is all the small caps. It's not as robust as the S&P, but it's still, pretty strong. So there's not a breadth problem in the US, that's for sure. And if we look at the Nasdaq, then that's also almost back at all-time highs. So certainly the momentum is very favourable in the US. And if we also look at So this is the Emerging Markets Index. So this is the MSI Emerging Markets. This includes China, but also has other emerging markets in it throughout Asia and South America. And this is a weekly chart, so you can see we hit a low in emerging markets in 2016, and then we've had, so that the index got down to under 27. We then had a huge move up to 52, so almost doubled. So emerging markets almost doubled from the start of 2016 to the start of 2018. Had got ahead of themselves, pulled back quite sharply, pulled back to 38, and I think we'll find this is quite possibly a 50% retracement, or pretty close to it, just a little bit over 50%. And now we're rebounding very strongly. We've rebounded back from 38, and we finished the week at 44. So that's quite a nice uptrend that is unfolding now. You can see we had an initial bounce back, and then we went sideways for about 5 weeks. If we zero in a little bit more and look at the Shanghai index, so again, this is on a weekly chart, and if I get rid of this massive peak here, which occurred in 2015, before the Chinese market basically corrected very, very severely, you can see just how strong this rebound has been in the Shanghai Composite Index, 2,500 points, and we're now at 3,250. So that's been quite a dramatic rebound. And if you look at where the China market used to be, you can see that there's still plenty of potential. You know, we've got at least another 400 points in the Shanghai market until we get back to meaningful resistance, and then we've still got a lot of blue sky above that. So a lot to like in some other markets. So my main markets of focus are obviously the US and China, and then opportunities within Australia as well. All right, moving on to the Australian market. Our dollar was slightly higher at 71, and you know, we're really still in a consolidation. We're in a downward sloping wedge pattern in a downtrend. So you'd have to think path of least resistance is ultimately a break of support at 69. Now, it's holding up at the moment, and it's being helped a little bit by improving commodity prices, but look, there's just so many things to be concerned about in the Australian economy. Our index was flat for the week, and as you know, I don't see a lot of opportunity in the top 100. There are a few stocks that are quite interesting, but most of my focus is on small and mid-cap businesses that have got excellent growth prospects, not only in terms of the rate of their growth, but also the reliability of, or the probability of that growth actually playing out. So there's lots of stocks in the Australian market that fit in that category. And I would then categorise them further into three different sections. There are some that will continue to operate. They're at excessive valuations now, and I'm talking stocks like Afterpay Touch, Altium, WiseTech Global, Appen, all those sort of stocks. Now they're at very, very high valuations, and some of them will continue at that excessive valuation because they've just got that extra X factor. They've got that bit extra that will disrupt and dominate the sector that they're in, and as a consequence, the share market is prepared to award them a significant premium. And that's what happened with Apple and Google over the last decade. If you go back 10 years, people were poking holes in the price of those stocks and saying how ridiculously absurd those prices were. But in fact, those businesses have grown to justify those stock prices at the time. And stocks like Afterpay Touch are quite possibly going to do the same. So, there's some stocks there that you just got to accept they're always going to be at a very high valuation. There's then a second category where they're overvalued, but they don't have that X factor. And so inevitably they will correct back. They might be trading on a PE of 40. They shouldn't be up there. At some stage they're going to pull back to perhaps a PE of 20. So they're the ones that you've got to wait for, and you've got to wait for some sort of decent correction. And then there's a third category, and there's not too many of these because the market's pretty good at nutting out the really good opportunities and pushing the price up. But there are a few that are fit into this excellent growth prospects, but they're still good value because for whatever reason the market just doesn't quite understand their business, or there's some perceptions that aren't necessarily totally positive. And one of the standouts for me in the Australian market is Webjet. I think this is a tremendous business that has a very high probability of continuing to grow at well above average rates, and represents good value now. So they're hard to find, those ones, but there are a few out there. And certainly that's one of the functions of portfolio analysts, to try and uncover those opportunities. So let's just take a look at the Aussie market. So I'll just look at the Aussie dollar. So you can see we're still in this consolidation within an overall downward sloping triangle that I think inevitably will probably break through support at 70 and renew the downtrend. So if we look at the ASX 200, bit of a roller coaster. We had a strong start to the week and then a very soft finish to the week, and gave back all those gains in the last 2 days. Okay, just while I'm here, let's look at the gold price. So this is the gold price on a daily chart. You can see really just went sideways last week, but we are still in an upward sloping channel, and we're managing to hold in the top half of that channel. So this was a channel that was established down here in the latter half of last year. We had strength in the gold price, managed to move out of that channel, and has now only been able to come back to the center of the channel, not all the way to the bottom. So certainly the trend is holding in gold. GDX hasn't done much. It's really been just going sideways now for about 8 weeks. A little bit of fluctuation, but we really need to see a breakout above, let's say, $24. All right, so we've covered that. Gold steady at $12.92, and that translates to an Australian dollar gold price of $18.20, and that's why the Australian gold stocks have been going so well. Now they're pausing at the moment, and that's to be expected because they'd had a great run. But I think you can buy Australian gold stocks, the gold producers I'm talking about, with with a reasonable degree of confidence on a decent dip. Because at $18.20 gold price, they're just so profitable that they're very, very good businesses. Other commodities, copper steady at 2.92. Crude oil moved ahead again very robustly, up about $3 on the week, and it's just been a continuation of the recent strength we've seen, and this is despite the economic backdrop around the world, particularly Europe. And despite a rise in inventories in the US, so I'm a bit surprised at how crude oil performed last week, and I guess I can only put it down to the fact that the China economy is looking better, and there seems to be quite a strong correlation between the perceived strength of the Chinese economy and the crude oil price. That seems to be one of the major drivers. There's the spot copper chart. So we've just been in consolidation mode now for a couple of months, and there's our 3 months crude oil price. So you can see we've had really a strong period since January this year. We've moved from 50 to 63. That's a 26% move in 3 months. So that's pretty substantial. So to wrap it up, just keep building your target list. You can't have a big enough target list. I get questions from people that are obviously the thrust is they've decided they want to get into a certain stock, and the question really is framed around, well, how do I get into this stock? I come at it from a completely different angle. I just get a really massive list of potential great stocks that I want to own, knowing that there's some of them I'll never get into. and I might spend years just watching the price go up and up and up. But I've been able to get into other stocks that I was able to get on my terms, and I would really encourage you to, if you're building your own target list, get several times as many stocks as you'll ever own. So if you're the sort of person that would own 12 stocks in your portfolio, then have a target list of 30 or more, because you won't ever get a chance to get into some of them. And you might have to wait 6 months or 12 months or even longer to get into some others. So make sure that your target list is big enough that you can afford to be patient and wait for this price to come back on your terms. It's just the smart way to go about investing. So determine what are sound fundamentally and technically. Determine what sort of rough price that is, and then just wait. And that's the art of ignoring the noise. That's the art of smart investing. Portfolio Analyst this week is just going to be more of the same. It's building the opportunity base. I think we really are building a tremendous opportunity base in Portfolio Analyst, and I think it's a very exciting period with some of the opportunities that are opening up. That's it for this week. There's my contact details for non-members. The Portfolio Analyst $1 trial for 2 weeks, of course, is still available. I think you'll find an enormous amount of education, market perspective. I think just generally a lot of value in that service. So that's it for this week. Cheers.